Joining us now with more on Coty's bust of an IPO and its strategy in Asia is Burt Flickinger. He's the Managing Director of Retail Consultant Group Strategic Resource Group. Thank you, Burt, for joining us tonight.
Thank you, Karina.
Okay, first of all, why was it a bust? Why were U.S. investors not impressed by Coty today?
It was a tale of one competitor versus several competitors in the same category, because you had the stocks of Estee Lauder, key competitors, L'Oreal, Procter & Gamble, all trade up and are near 52-week highs. So while Coty traded down, not having the size and the scale and having losses in recent years to invest in China and throughout Asia, Coty, while it has good brands, is not really connected with Tmall, 360buy.com, Jumei, where internet cosmetics and fragrance sales in China are going up 400% to 500% a year, and consumers are moving away from the traditional retail stores and buying much more online.
Okay, so speaking of the emerging markets, only 23% of Coty's sales or revenue actually comes from emerging markets. So plenty of growth in the emerging markets, and they've obviously set their sights on China through the purchase of TJoy. Now, how much growth potential is there really in China for multinational cosmetic companies?
Tremendous potential, because China is currently about a $24 billion cosmetics and fragrance market compared to the U.S. of 36. So China's already about 2/3, and with more women working, higher wages, higher levels of disposable income, and the Chinese shoppers are very savvy, smart shoppers. So they'll save more online. The more they save, the more they buy. So the cosmetics market will really grow geometrically in China, where it's only growing arithmetically in the U.S.
Having said that, we know there's great growth potential there, but they've been having troubles really making inroads into the Chinese market. We see that the revenue for TJoy fell 50% last year. This is after it was bought by Coty, and L'Oreal's acquisition of China's Yoka has also run into some problems. So why has it been so hard for these foreign cosmetic companies, even though they've bought Chinese companies, to really understand the Chinese market? What is the problem there?
The problem is really selling in the inland provinces like Gansu. If you're selling in Shanghai, Beijing, Guangdong, it's very easy to sell through retail stores. But where there isn't the distribution set up in the inland provinces, from central China to the outer provinces, the degree of difficulty is much higher. So even Avon, which has a direct sales force, had a significant decline in sales, to your point, Karina, in China as well last year, and that has to be corrected by all the companies. So Procter & Gamble has gone more online with SK2. Estee Lauder had a 400% increase in online sales, and that's going to be the model that'll work the best to build the business.
Is there also a problem, though, in different management styles when it comes to how Chinese companies are run versus U.S. companies?
Definitely a different management style. That's a really prescient point you're raising. Is the U.S. style tends to be more command and control and centralized marketing, where if you look at comparison in the candy confection category, Hershey, which is more social, digital, working with Alibaba, Baidu, has increased its sales of chocolate nearly 30%, much more than the cosmetics companies. And some of the Hershey's brands increased 83% last year. And Hershey's works very well across the provinces, with the people, with the stores, with government officials, really on a 360-degree basis. The way Hershey does it is the way everybody should do it.
So are you saying that really they have to use the internet much more in order to generate their sales in China, much more than they do in the developed markets?
You're completely correct, because the internet is, you're having growth of 500% to 600% on an annualized basis on internet sales, where land-based sales in stores are down 9% to 10% a year in China.
All right, so that should be the strategy going forward. Burt, thank you so much for joining us today. That was Burt Flickinger. He's a retail consultant group from the Strategic Resource Group.